Okay, Kelly, you talk about how you can borrow against your insurance policy, you can leverage it, create arbitrage opportunities, but what kind of interest rate are you borrowing it at? So I got this comment here recently. Person's like, all right, yeah, but at what interest rate are you borrowing from these things? This is an absolutely fabulous question. There's only one answer because there's an interest rate, but the impact varies. Now, right before you issue the policy, you have a choice. You can choose fixed interest rate for the life of the policy or variable. And I typically choose variable. And here's why. Because interest rates tend to fluctuate, tend to follow and shadow dividends. I don't ever want to be in a position where maybe my fixed interest rate is much higher than my dividends. So I always choose the variable. Right now, interest rates on a lot of policies we've implemented is 5.5%. So if you had $1 million in your life insurance and you took a loan of $100,000 against it, you get that $100,000. You could do anything with it. You could spend it. You could do whatever you want. You could go deploy it into an opportunity that maybe brings you 120 grand. You could bring that money back, pay that loan off, and it would be 5.5% of simple interest, and that's for the year. So that would cost you what, $5,500 for the whole year. If you paid that off in 6 months, well, it's going to cost you half of that, which is what, $2,750? Because it's a simple interest calculation. Here's the kicker. In a non-direct recognition dividend structure, and I highlight that in this video here, where I talk about the 4 characteristics of insurance companies I look for. In a non-direct recognition dividend structure, in that example, your entire $1 million is earning the full dividend. And just this 1/10 of that value, being the $100,000, is being charged the $5,500 for the whole year of simple interest. So if this entire dividend is, say, 20 grand, and I'm borrowing here and I've got a little cost here at $5,500, and I can use that money to go deploy it to bring more money back, I've created an arbitrage. I'm using some money at a cost, and I'm not losing the opportunity to earn on my entire balance. That's mathematically advantageous. Now, let's just pretend for a moment that you could get a $1 million policy loan against a $1 million cash value, and you had a 5.5% simple interest loan, and then let's say your dividends were only at 4.5% that year. You can't borrow 100% of your policy because you could risk lapsing it, but let's just hypothetically say that's the case. My cost in that example would be 1% higher than my earning. So in that extreme example, the cost of that money to me is 1%. That's it, just 1%. Worst case scenario, my earnings are a little bit less than my loan rate. And see, this is why I always choose variable, because worst case scenario, it creates an extremely low cost to borrow. So is there a cost? Yes, but think about it. There's a cost in everything you do. If you have $100,000 in your bank account and you go buy a car, you pay cash for 50 grand, well, there's a cost. That $50,000 can no longer earn for you ever again in your entire life. And your investment account now is only earning at 50,000. So you have to correlate the cost. There's always a cost. You can't get away from cost. But in this example, when you have the ability to control the transaction and get some of the cheapest money, create a positive arbitrage on that, or worst case, the cheapest money in the market you can get, then yeah, this is why people leverage their insurance. And think of it this way, when it comes time for distribution, so the example I've given in a couple videos of the guy that has 420 in cash flow, he's taken policy loans. He has like $8 million in his insurance cash value, and he's taken a 6% distribution or like a 5.5% distribution, and there's a little interest expense. He doesn't pay it because his entire $8 million is earning a dividend. The next year, another one, he doesn't pay it. The next year. It's a collateral spin down, not a depleting spin down. I have a video on that too. So this collateral capability puts him in a position to take a larger percentage than a safe withdrawal rate out of a normal investment and have it live on much longer. So over the years, is he going to have a sizable loan? Yep, but his 8 million's doing this. Okay, Kelly, he's got to pay the loan off. Yeah, the insurance companies are always in it for the long haul, period. Long haul everything, long-term bonds, everything they do. And 100% they know you're going to die. So when you die and you leave your beneficiaries money, the death benefit pays off the loan and the beneficiaries get the rest. Boy, this video is long. Now see, this is why some people supplement with term insurance. This policy design isn't specifically to award everything that they want to be awarded to at their death. It's for the purpose of them having all the control, the IRS off their back, a bigger spendable income, a hedge against inflation, all that that. This policy is designed for that purpose, and it accomplishes that with extreme efficiency. So the loan always gets paid back. So are there loan rates? Yep. Does it still work in your favor? Yep. But it's still one of the most efficient distributions you can have. Okay, so if you find this valuable, please like it, please share it, please leave me a comment. Know that you're loved, know that you're blessed. Have a great day.